So this is an education session with Integrity Capital. We're here with David Froschauer with Society General. He's gracious enough to spend some time just giving us an overview of the, CMBS markets, commercial mortgage-backed securities. Going to walk us through the nuances of that, and then probably talk about just process as well. So, David, thank you for taking the time.
Yeah, thanks, Dave, for the introduction.
Yeah, absolutely. So maybe you could just start off with, what is CMBS and how does this whole thing work? It could be a little fuzzy for people, so maybe you can fill us in.
Sure. So as you mentioned, CMBS stands for Commercial Mortgage-Backed Securities, and I work for Society Generale. We're the third largest bank in France, and typically CMBS lenders are money center banks or debt funds, and the business is often called the conduit business. You'll hear it referred to as a conduit business, and conduit is essentially, by definition, it bridges point A to point B. And so in this situation, what we're doing as a conduit lender is we are financing properties. So we're making loans as lender on commercial real estate properties. And then we, in conjunction with our partners, we bundle loans together and create a bond offering and then sell those bonds to institutional investors, pension fund advisors, hedge funds, and the like. So primarily life insurance companies are big buyers of CMBS bonds. So we're the pass through. Okay. And so whereas we differ in the sense that a typical bank, when you make a loan or a bank gives you a loan, then that loan stays on the bank's balance sheet for the duration of the life of the loan. In our situation, it stays on our balance sheet until we securitize it, into which it's then goes to a servicer who is servicing the loan on behalf of the bond buyers, who now, in essence, own that loan. So
is that how kind of it works then, David? So like you've got this, these third-party groups that are like life companies, insurance companies, pension funds that are these buyers of these bonds.
Mm-hmm.
I have a rating agency that's rating all these bonds. And so what exactly, so you're packaging these up in like different tranches based upon the risk, or how does it get bundled up? Like how does that actually work?
Yeah. So when we initially size a loan and price a loan, we're making assumptions based on how we think the rating agencies will treat the loan. Okay. And so to your point, then rating agencies will tranche an individual loan is the same way that they'll tranche the entire offering. And based on their analysis, then that in essence triangulates to pricing that we then communicate and offer to the borrowers and to mortgage brokers and bankers like yourself. So on one hand, it is a bit of a guess from the onset, because you're never entirely right. Sure. We're making assumptions for variables that surround the underwriting of the asset, and then so that, which is very important, and then that coupled with where we think the bonds will ultimately price when we go to securitize them, and so that then dictates our pricing as well. So and the rating agencies have a big effect on that, and they are largely the determinant in whether your loan has a good rating or whether it has a not so good rating, which then corresponds to higher pricing.
Yeah. So basically, at the end of the day, you're bucketizing these based on risk and all the other elements to it, rating agencies finalizing that, and then you're charging this, and then, somehow you're making the spread between here and what you sell it for,
Right.
there's some gap there
Hmm.
where you're making a premium, hopefully if you priced it appropriately.
Right.
And so that trades off your books, you get your spread of the income between X and Y pricing, and then it, trades off. So this is basically driven by the market
Hmm.
as a whole. So if the market gets too wonky, it could be risky, kind of like during COVID, it shut down, predominantly, I'm guessing. So, uh,
Right.
yeah,
Right.
yeah,
Yeah. No, that's exactly right. And I mean, we typically what cause disruptions in our business are major macro events such as COVID,
yep,
and COVID being a good example because we it's taken us a while to dig out of COVID because we we were part of a syndicate that financed Blackstone's purchase of the controlling interest in MGM Grand
mhm,
and Mandalay Bay casinos.
yep,
We funded that in January of 2020. So that was very poor timing
yep,
because the casinos closed down, and there was good credit behind the bonds, but we couldn't market them. We couldn't sell them. Or we could sell them, but if we did, it would have been at a
yeah,
huge loss
discount,
for us.
yeah,
So yeah, all of a sudden that spread premium where we thought we were going to make money, all of a sudden we're now not making money. And in fact, we're losing millions and millions of dollars.
yeah.
So that's the risk in our business, and it was certainly exacerbated by COVID.
So tell us a little bit about like the structure of an individual loan. So somebody's going to come in, you're probably looking at stuff that's more, 4 to 5 million and higher.
Right.
Uh, and what typically is a general structure that's going to happen for like your apartments, office, retail, industrial? How are you pricing that? What is the terms typically on those? Maybe you can walk us through that a bit.
Yeah. So the vast majority of what we do is 10-year fixed.
Okay.
So we have a 5-year and a 7-year product, but they don't typically price as competitively as the 10-year product. So in fact, I can't remember the last time I've closed a 5 or a 7-year loan. Everything is primarily 10-year fixed.
Okay.
So it's and then number two, it's all non-recourse.
Okay.
So our loan terms are typically attractive to individuals or funds that need non-recourse or want non-recourse. So that's another. I think that's another characteristic of our loans that's important. But back to your point, typically it'll be a 10-year term. It's the loan rate is fixed. We lock the rate right at the closing of the loan, literally on the day of the closing of the loan.
Okay.
And so there's we can go up to 73% LTV is kind of where we max out. There's typically some level of interest only. It can be up to 10 years of interest only for lower leverage loans. The loan, as an example, the loan that we're doing together, the apartment in the Central Valley, is 73%, and I believe 73% loan to value with 5 years of interest only. So one other thing that's worth mentioning is prepayment, because that's something that is something that we don't have very much flexibility on. So similar to Fannie and Freddie loans, the prepayment is either defeasance or yield maintenance, which is just another calculate. It's just two separate ways of calculating what basically the paying out the remaining interest on the loan for the balance of the term. So what does that mean? That means that if if you have a client that wants to sell their property in the next 2 years, then we're not going to be the best route for them. Or if they want the ability to pay it down faster than the amortization schedule, if they want the ability to pay, like I said, pay it off in 2 years, or even if they're selling, any scenario where they would want to refinance the loan prior to, call it, year 9 of the loan term, it's going to be very punitive to the borrower and just won't make a lot of economic sense to them. So I like to have that conversation up front, because as I tell my clients, when you do a loan with us, it's because you want to hold the property for 10 years and then refinance it again in 10 years.
That's good. So basically on the defeasance, would you be fair to say it's a make whole provision in the sense that you're pretty much going to pay what you would have paid, for the life of the loan, except for, whatever you guys think you'll make in the bonds, for the time period that you sell those off, you could make out sort of even or pay at least 1%, but it'd have to be pretty dramatic defeasance, because it's fairly complicated.
Yes, and there's no magic formula to it. As if you've calculated defeasance for your client, there's Defease with Ease is a website that even I use when I'm calculating it, just to give you a baseline of. But yeah, typically, unless you're defeasing in the last 3 years, 2 or 3 years of the loan term, then the prepayment penalty is going to be so high that it just doesn't make any economic sense to do that.
Yeah, that makes sense. And what's generally costs to do a loan? What should somebody be expecting?
Depending on the complexity of the loan. If it's multiple properties, then obviously you have more third-party reports, which are which make the expenses higher. But we don't charge any origination fee, so all of our pricing is at par. We just charge an expense deposit up front that we anticipate will be used to cover all of our expenses over the course of the loan closing. So on our loan, it's an $8 million loan. I think the lender legal will come in around $25,000, and it'll be another $25,000 or so for the other third-party reports, insurance review, zoning, public record searches. We have a due diligence consultant that we engage to help us catalog all the information and help us through our credit process and securitize the loan. So it's going to be all in $50,000, and then if you were doing a portfolio of properties, then maybe it goes up another $10,000 per property.
That's great. So somebody comes in, they price a loan. What's the process from there? You give somebody a quote, broker, they go take it to the client. Client says, I like it. Maybe there's some minor negotiation going back and forth. What happens then? Like, what's the kind of the process to get it done?
Yeah, so the process for us, and it does vary, I think, depending on who you're working with, but we tend to do more work on the front end and have more conversations internally on the front end to ensure that everyone that ultimately signs off on the funding of the loan has reviewed the loan terms, is comfortable with them, and has kind of given their blessing to move forward. And so typically, if everything works out in diligence as we had anticipated, and the market is the same as where we had anticipated, then we close at those terms. So if the client likes the terms, then you would request a term sheet,
Okay.
So then we go through, that's when we go through a formal process where we put together about a 10-page memo internally that we circulate to all members of our team. They review it, sign off on it, and then we have the ability to offer a term sheet that can then be signed by the client. And the term sheet is essentially the framework for the loan documents. It's a summary of all the different terms that are going to be in the loan documents, and it's just the template for writing those documents.
That's great. So somebody issues an application, they sign the application, and then do they send in a deposit to you then?
Yeah. So then they send in the wire. They wire in the good faith deposit,
Okay.
and then from there we basically go right into closing. So we order third-party reports. We establish a kickoff call with attorneys. We start gathering due diligence. We start putting together our credit presentation. We see the property. And then we will have calls on a weekly or bi-weekly basis, just with all parties involved, just to update on the status of various items that are outstanding. And we can typically move pretty quickly and close in 30 to 45 days is what we typically strive to close in.
That's great. Yeah. So CMBS is a good product type for larger asset deals,
Yep.
Income producing properties. Someone
Right.
that wants non-recourse, somebody who wants probably a little better on the leverage, maybe they want interest only.
Yep.
Could be something that there's a quirk or two that couldn't fit in Fannie Freddie, so that might
Right.
be something that you guys offer value to. And
Yeah. Yeah, and it's worth noting, everything that we do is based, all of our loan opportunities are deemed stabilized or near stabilized. So anything that has a future funding component or any value add component to it probably does not work for us.
Yeah.
If you have a situation where, and I'm working on one right now, where you have a brand new building that's 85% leased and they have LOIs to lease out the remaining space, the sponsor wants to finance now, and it would be a big cash out to the sponsor. We have ways of structuring around what we'd call near-term events. So a building that hasn't leased up, has LOIs, we can hold funds back once those LOIs are converted to leases and the tenants are paying rent and in occupancy, then release the funds to the client. So if it's something where we can see clear sight to a change in the cash flow, then we can structure around it. If it's something that's more arbitrary, like a 100% vacant building, and they're going to try and lease it up, but if there's no cash flow on it, then we wouldn't be a fit there. So everything we do is based off of cash flow.
Is it if you have so it would be safe to say that it's apartments, storage, industrial, office, retail?
Yep.
It's pretty much going to cover the gamut.
Hospitality is, we're looking at again. We traditionally been a good source for hotel financing.
Okay.
It's a little bit trickier today because most hotels didn't do well over the past year, over the past trailing 12 months. Some have done really well, which also makes it a little bit tricky. But and in the past we've been a really good source for hotels, and we have traditionally done about 30% of our business was hospitality. So that went to zero. But now we're starting to look at new opportunities again. So I would just add maybe manufactured housing is another sector that we like.
That's great.
Medical office is good. And some single tenant medical office we've had some success with.
And I guess couple more things real quick and before we land the plane on this. So from an underwriting perspective, so you're going to look at, rents, take probably a vacancy factor, whatever the operating expenses are, come up with a net income, and then you're going to strip off like CapEx, so capital expenditures typically, and then TILC. How are you typically calculating those numbers generally to underwrite in a sense for TILC and CapEx?
Yeah, that's a good question. There is a formula that we use, and it's based off of what we think market tenant improvement allocations are for new leases, and then what they would be for renewal leases, and so we make that assumption, or we fill in those variables, and then apply a renewal probability to those leasing assumptions, and then essentially we have a model that forecasts what will potentially be needed in future TI and leasing commission expenses over the course of the loan, and then we would try and reserve annually to meet those obligations.
Okay.
It's a guess. It's never accurate, but that's typically how it's done. It's not. There's no kind of linear math to it. It's based on a couple different variables.
Factors, yeah, because I know some groups will do like, 10 cents a foot or $1.
Yeah, largely it'll depend also on the rollover. So if you don't have near-term rollover, or if your largest tenants their lease rolls outside of the loan term, then it's going to be a much lower cost. And then the CapEx is easy. That's just based off of the property condition report and what the engineer expects they'll need. Again, same principle. What the expense will be over the loan term, and then it's inflated a little bit from there. But so if you need a new roof in year 2 or year 3, then it's going to be a bigger number, because we're going to budget for that. If everything's brand new building, it's going to be a very small number.
Okay. And then do you actually, and I guess you impound for taxes and insurance, and then you're more than likely going to impound for, like an apartments, it's $250 a door.
Right.
And then, CapEx and TILC be predicated based upon the scenario with respect to, if it is dilapidated or the property condition report comes back, then you're going to be impounding for those things on an ongoing basis in the loan.
Yep.
Yeah. Okay, that's good. Well, that's really helpful. We really appreciate you just, educating us on that. It's helpful to kind of understand the overview of the market, a little bit of how you guys handle, process, and just understanding the logistics and terms and things like that. And so, is there anything before we, end on this? Is there anything else that I'm not thinking of that you want to make mention of, or do you think that pretty much covers it?
No, I mean, there is another, I think, player in the overall picture that it is worth noting, because we haven't touched on it, but as you research more about CMBS and learn more about it, it can be another factor, and that's the concept is the BP spire. So for every pool of loans, so let's say, for round numbers, there was a $1 billion pool of loans. So once the rating agencies go through, they, as you mentioned, they tranche out the loan. So they create the different classes based on, based on the subordination. And then there's a class at the bottom that's not rated. And so what that means is you can't go and sell those bonds to the open. You can only sell the rated bonds to the market. So what you have to do is you have to find an investor to buy that bottom portion of the capital stack. So they're buying, and that's called the B piece buyer. So the A piece is is the bonds that will be securitized and will be sold to investors. And then the B piece is the secondary part that's sold to one single investor. And they're taking the first loss position on the entire pool. So if the troubled asset, if an asset goes bad, then they're going to be the ones to suffer the loss first. So they are, in essence, they are the gatekeeper for what comes in and out of pools of loans. So that's one thing that we are cognizant of, and we try and focus on opportunities where there is not a lot of BP buyer risk, meaning that the risk that you try to securitize the loan and the BP's buyer comes back and says, we don't like this loan, we don't want it in the pool, which has happened and will continue to happen. So
when you say, let me clarify that a little bit, just so basically you get this pool of $1 billion of loans. The rating agencies kind of chop block this based upon tranches. And then you're saying there's this portion of the pool that they say, hey, this is just too risque.
Correct.
For this thing to go into the securitization.
Right.
And then you have to find an individual investor to say, hey, we'll take that portion.
Right.
Would it be safe to assume that that would be tantamount to somebody taking a second position behind a first?
Yeah, exactly. That's a good analogy. And just to give you some context, the AAA class, which is the biggest senior class of the capital stack, that's all. I think the last loan or the last securitization we priced was priced at 66. So what that means is those bonds paid a interest rate to the investors of call it maybe 2.2%.
Okay.
Very safe position. Maybe your 30% LTV is where where it cuts off, but it's a 2.2% interest rate.
Okay.
The BP buyer gets a low to mid-teens return on that piece. So I think the one that we are, the securitization that we're working on right now, I believe the BP buyer is at like a 13.75% interest rate.
Oh,
so
is it, would you say that they're like the top 15% of the stack, meaning that
or the bottom, the bottom.
Bottom.
Probably 10 to 15%.
Okay, yeah, that makes sense. So yeah, that's good. So those have to get kind of priced accordingly because they're taking that riskiest portion, and then so it's almost like you're taking that sliver and discounting it to give them the yield. Is that safe to assume?
Yeah, well, it all blends
together to the final note. That
right.
Yeah, because the AAA guys, they're at 2.25. That's below your coupon, so they're kind of below. They're higher, so this sort of all balances out to get to it. Yeah, that makes sense. Okay, that's good. Yeah, that's really good to know because you have all these players in there. You've got the servicer that's servicing the loan, the buyers and investors, BP's buyers over here buying it. You guys are kind of quarterbacking the whole thing, closing it, prepping it, facilitating it out to these individuals in order to make this transaction, take place. So yeah, that's really good. Super helpful. So thank you so much for doing this and just educating us in Integrity Capital so we can just be more informed to send stuff your way. So
yeah, and if you have any questions, I don't know if your folks on the line have any questions. I've got a few minutes if anybody wanted to ask any questions. You can do it now, or feel free to share my information. I was trying to be very responsive and happy to answer any question, and even as as easy or simple as it may sound.
Yeah, no, you've been great to work with. And why don't you just let everybody know your contact information so they can get a hold of you? What's the best way to call you and what's your email, David?
Yeah, my email is david.froschauer. So that's spelled F as in Frank, ROS as in Sam, CHAUER at SGCIB.com. So Societe Generale Commercial Investment Bank.com, SGCIB.com. And I mean, as with most people nowadays, cell is probably the best way to reach me, and that's 949-500-5931. I know you guys are in Phoenix. I'm close by in Orange County, California. So do a lot in your market, and yeah, love to keep working with you guys.
Absolutely, vice versa. Well, thank you so much, David. Appreciate your time, and we will definitely be in touch with you.
Okay. Thanks, Dave.